So good morning. Thank you for joining the webinar today. We're thinking about funding defined benefits. The webinar is being run jointly by First Actuarial and Gowling. Liz and Ellie are experienced pensions lawyers. They work for Gowling on a number of defined benefit schemes and support both trustees and sponsors. Marcos works alongside me at First Actuarial. He's a scheme actuary, but he does also support pension scheme sponsors as well on several matters. Our speakers plan about 30 minutes covering the slides. And after that, there'll be an opportunity for questions. There is a Q&A box on Zoom that you can use to type your questions anytime during the session. We'll cover as many as we can of those. The session is being recorded, and the recording and the slides will be made available after the session. But without further ado, I'll hand over to Liz, who will start us off.
Thanks, John. So we start today's webinar with a summary of the funding changes which were introduced by the Pensions Schemes Act 2021, and we'll give an indication of when we expect those changes to come into force. We'll then look at the current position of the long-awaited revamp of the Defined Benefits Funding Code, and then we'll move on to some examples of what we're seeing in practice between Gowling and First Actuarial in terms of regulatory engagement and case studies, before finishing with some key takeaways for trustees and employers with DB schemes. Well, Marcus and I last spoke together at a webinar 2 years ago on the current trajectory of the Pensions Regulator. That was January 2020, and you can appreciate that for lots of reasons. The world felt like a very different place then. And one of the most tangible changes we've seen to the pensions regulatory landscape since then has been in the form of the Pensions Schemes Act. I don't know whether we could move on to the next slide. That would be great, thank you. So the Act received royal assent just under a year ago, but with many of the key changes only coming into force in October last year, and a number of those changes are yet to come into force at all. So we're not focusing on the strengthening of the regulator's powers introduced by the Act. There are 2 other Gowling webinars you may want to take the time to view to get up to speed on those areas. But instead we're focusing today on the funding of DB schemes, what we know so far, what we don't, and what's coming down the tracks. So given the significant changes introduced by the Pensions Schemes Act 21 more generally, the change to the funding requirements isn't revolutionary, I think it's more evolutionary, reflecting a direction of travel that the regulator has been encouraging trustees to follow for a long time. For example, a theme of recent TPR annual funding statements has been a focus on encouraging schemes to plan for the long term. And this very much fits into that longer standing expectation that schemes take an integrated risk management approach to scheme funding, covenant and investment. But I think what's different now is that because the scheme places the long-term funding target as a specific statutory goal for DB schemes, that very much brings the funding element of integrated risk management to the fore. And of course, the changes to the scheme funding requirements sit alongside the other high-profile regulatory changes introduced by the Act, as we saw on the previous slide. And whilst those regulatory changes are definitely prompting a lot of interest from employers, certainly in our experience, it's the new funding requirements that represent the biggest direct change for trustees. So in short, we've got this new requirement that the employer and trustees agree a long-term strategy for ensuring benefits can be provided over the long term. And that it builds on the existing scheme-specific funding approach that we have set out in the Pensions Act 2004. And in practice, we both know, as between Gowling and First Actuarial, that many schemes have already started that long-term journey planning, with schemes a fair way down the route of buy-in policies, liability-driven investments, or member option exercises either underway or indeed completed. And much of this we'd see as sensible ongoing risk management for your schemes. And indeed, in the consultations that preceded the introduction of the Act, the government estimated that around 80% of schemes have already got some form of long-term funding strategy in place. So it's not a massive game changer in that sense. But certainly the concern expressed in the lead up to the introduction of the Act was that this sometimes presented itself as a loose set of objectives and was as loosely aspirational rather than a defined strategy that drives this long-term thinking and planning. So very much this is about requiring trustees to engage properly in this process and thinking beyond the limits of the immediate triennial valuation. And there'll be some teeth to reinforce this new aspect of the Act. So a breach of the requirements can give rise to civil penalties of up to £5,000 in the case of an individual, or up to £50,000 in any other case. So what are the two new funding requirements introduced by the Act? Well, we've firstly got the strategy, and this sets out the long-term funding and investments target for the scheme. So the technical provisions will need to be calculated consistently with this strategy. It must be agreed with the sponsoring employer and kept under review. So key point is that this strategy will have to feed into all other aspects of the scheme funding. So the statutory funding objective, recovery plan, and as I've mentioned, the technical provisions. So in practice, the technical provisions will become milestones on the route to achieving that long-term objective. The second new element is the chair's statement. And this is where the trustees will have to really do the thinking about the success of the funding and investment strategy. So how are risks being managed or mitigated? And there will be a requirement for a reflection on past decisions and lessons learned where relevant. And that aspect requires consultation with the scheme employer. So in effect, the statement is how the strategy is going to be regulated, a way of demonstrating that that strategy isn't just a one-off decision that's put away in a box somewhere, but something that's revisited by the trustees and reflected on. So it's really about transparency and accountability about the risks that are being taken in terms of that long-term funding strategy. So key question is when does all of this come into force? Well, I mentioned that the Pension Schemes Act received royal assent last year. We've got some aspects that came into force, but the funding target has not yet been introduced. And we're all waiting here for the DWP's draft regulations on funding, which we expect next month at the earliest. Currently, our expectation is that the long-term funding target will apply to triennial valuations after this year. But what this doesn't mean is that trustees can just simply sit tight and not take any action until then. So I'll come on in a moment to what you can do. But meanwhile, key takeaway here is that we await the draft regulations, we await a consultation and a new code of practice which will set out so much of the detail that we need here, particularly around the timings, which valuations it's going to apply to, and the key matters that are going to be taken into account when that long-term funding target is set. The other key point really to conclude on here is just that I think this is another key area where the regulator is going to have greater visibility on what's happening in practice, and consequently another opportunity for it to intervene where it considers appropriate. So in that context, well, what can scheme sponsors and trustees do now? Well, our message is definitely that the trustees and employers should engage now to start looking at that long-term funding and investment strategy for schemes. Obviously, that might be endgame solution being buyout or entry into a consolidator. For a stronger employer, that might even be a run-off situation. And for open schemes, a different approach might be needed. And Ellie and Marcos are going to touch on the regulators' recognition of the different position of open schemes here. But the key takeaway is there's nothing to stop you from already taking a long-term funding approach, pending those regulations and further guidance. And it does mean you'd be on the front foot when the regulations are published. And considering the long-term funding target is, as I've mentioned, consistent with the regulators' existing expectations that we've seen here. And also, just in the context of that last point I made on the last slide, given the increased regulatory oversight and scrutiny of DB schemes, taking steps to agree a long-term funding strategy is also likely to place trustees and employers in a better position in the event of future possible TPR interest. We'll come on to cover what we're seeing in practice here, but there's no doubt that a joined-up approach to long-term planning will best protect trustees and employers following the introduction of this new regulatory regime. So I'm going to hand over to Ellie, who's just going to give an update on the DB Code of Practice.
Thanks very much, Liz. Good morning, everyone. Yes, I thought it would be helpful to start off with an overview of where we are. This timeline shows the development of the government and the regulators' approach to scheme funding. It started back in March 2018. We had the white paper on protecting DB pension schemes, which you may remember. And then the regulator's first consultation on the new DB funding code was not published until 2 years later, in March 2020. And this consultation closed in September 2020, 6 months later. Meanwhile, we'd had the major pension schemes bill published in January 2020, and that received royal assent, as Liz said, last year, in February 2021. Alongside this, we've had the annual funding statements in 2020, 2021, And it's likely that we're going to have the annual funding statement for 2022, as well as the new draft funding regs that Liz mentioned, before we see the second consultation on the revised funding code. The current forecast from the regulator is that the second consultation will be published in late summer 2022, so around 2 years since the first consultation. And in terms of when it's going to take effect, our current best guess is early 2023. So what do we know so far? Well, the main headline grabber from the first consultation was this twin track approach of fast track and bespoke. So the concepts of submitting an actuarial valuation on a fast track basis, i.e. demonstrating compliance with a minimum standards, or a bespoke basis for any valuations that don't fit into the fast track route through the valuation process. And where trustees need to explain why it's reasonable to take a different approach from the fast track. The fast track is intended to be easier for the regulator to sign off, and Marcos will give us some more detail from an actuarial perspective on that later on. What else do we know? We know integrated risk management remains key, and we know that the regulator has a focus on reducing the reliance on sponsor covenant over time. The regulator is keen that mature schemes should not carry a larger risk than their covenant can reasonably support, and that goes to this encouragement to all schemes to reduce their reliance on the covenant. So we've not seen the second consultation yet, but we did receive an interim response to the first consultation in January 2021. And this was one of the largest response, or the largest response that the regulators ever had to any of its consultations, 127 responses and some 6,000 comments. Understandably, the regulator has said it needs to work through all of these comments and the issues raised, as well as learn from the draft funding regulations that Liz mentioned, which we expect in spring to help develop the fast track guidelines. So the interim response, it was a short response, and it drew out the themes of the concerns raised by the respondents. And some of these were comments around the concern that flexibility would be lost. Does benchmarking the bespoke route against the fast track result in a loss of flexibility because every deviation from the fast track needs to be explained and justified? Will the bespoke route be more burdensome in terms of documentation? And will it result in more regulator engagement, which some schemes regard with a degree of apprehension? And then moving on to the next slide, another concern that was raised was open schemes and the different position for open schemes compared to closed schemes, and how that would be addressed in the new funding requirements. As you can see from the slides, we've got two quotes there, one from the government and one from the regulator. And these indicate that they understand that there's a difference between these schemes. We know the regulator wants schemes to reduce its reliance on employee covenant over time, and we know it doesn't think mature schemes should carry a larger risk than the covenant can support, but it does seem to suggest in its quote here that it understands an immature scheme, so an open scheme, typically a more immature scheme, could carry more volatile investments and more liquid investments, so take a different strategy to a closed scheme. And the government here has given an assurance that it doesn't propose to treat all open schemes in the same way as closed schemes, although how that translates in practice remains to be seen. So what do we not know? Well, much of the detail. The key principles from the first consultation are likely to be refined in light of all the consultation responses, the ongoing challenges presented by COVID and Brexit, as well as they'll need to be consistent with the new funding regulations. We don't know exactly how the regulator plans to distinguish the treatment of open schemes, and we don't know how TPR intends to engage with schemes to enforce these new funding requirements. And finally, we don't know when the DV funding code is going to be introduced, although I think we can be sure it's unlikely to be this year, and it may well be early next year. Now I'm going to pass it over to Marcos, who's going to talk to us about, from an actuarial perspective, long-term funding targets.
Thank you, Ali. Good morning, everybody. I'm just going to build on some of the things that Liz and Ellie have introduced so far and look into a little bit more of the detail. for those of you that attended the webinar a couple of years ago that Liz mentioned earlier, those are very much the sort of key things that you as trustee and the regulator is looking for in terms of funding strategy. Not going to go into the detail that we went through on that occasion, but just as a brief reminder, just some of the things that we need to look at. So if we can move to the next slide, please. So one of the important things to think about in terms of the long-term target is that the intention is that target should be what's been called a low dependency and low investment risk target. So the idea of this graph, which you may have seen before, certainly it's a variation of something that the regulator put in the consultation, just to illustrate the principles, is that the dot on the left-hand side there at the top represents your scheme now in terms of the amount of investment risk that is taken. And then over a period of time, the intention is, certainly for closed schemes, that dot should move to the other one on the right-hand side, which is labeled LTO, long-term objective. And at that point, the scheme should be taking a lot less investment risk and be sort of more funded so that it relies less on the covenant support of the employer. Now, I'll come on to the amount of time that you've got to get from one point to the other in a moment. But before doing that, the other concept that's coming in is this idea that you should have a journey plan, or how are you going to get from A to B, if you like. So those lines there in the graph, the green line and the other lines are meant to represent journey plans. So if I just take the green one, in that case, what's that's trying to demonstrate is the trustees and sponsor of a particular scheme decide that they're going to keep the existing amount of investment risk and therefore return going for a while until they get much closer to the target, and then they decide to de-risk. Obviously, there's an infinite number of ways that you can get from A to B in this case, and the other lines are just meant to represent gradual de-risking of the investment strategy over time, which is obviously something that lots of schemes do. If we can move on to the next slide, please. I sort of mentioned the amount of time that schemes are expected to have to get from A to B, and that's very much meant to be driven by the maturity of the scheme. And the consultation talks about significant maturity and actually gives 3 different ways that it could be measured. Now, don't worry too much about this graph, but it's just an illustration of how we're trying to assist clients actually measure duration into the future. So the line to worry about here is the blue line. And you see that over time, because this is a closed scheme, the schemes get gradually more mature. Ellie mentioned active schemes. And if you were to do one of these projections for an active scheme, that line could look very, very different. So just to bear that in mind. But I think this type of approach is very helpful for trustees, and also I think this is quite representative of a lot of DB schemes. So in this particular one, the consultation talks about getting to the LTO when duration is down to 12 to 14 years, which could be in 5 to 10 years, and that we think is going to be something that a lot of schemes are going to be experiencing. So, I mean, it's definitely something that you need to be thinking about now, because you've only got probably 2 or 3 valuation cycles to think about, unless you are a particularly immature scheme or an open scheme indeed. So moving on to the next slide. Again, you may have seen some of this modeling or similar in the past, and the intention here is just to highlight some of the things that you could be doing with your advisors and options that you should be talking with the sponsor about what that long-term objective should be, and then doing some modeling. And the idea here is to you can look at the funding and the investment together. So this model would allow you to look at variations in contributions and also different investment strategies. So if you like the journey plan that I showed you earlier, different ways of getting from A to B. And I'm not going to sort of go through all this now, but then you're meant to be looking at risk. And what this does, and it's another important aspect of this new funding code, is that you need to make sure that the funding strategy and the investment strategy are aligned. So another way that you could look at it. I mean, this is something that our investment team use here, and if you're interested in the detail, perhaps we should have a separate conversation. But I just wanted to highlight some of the things that we can use to help trustees and sponsors come to that strategy. If I can move on to the next slide, please. So we'll have the slides afterwards, and a lot of the modelling and the discussions, they can sound very complicated, and indeed consultations run to nearly 200 pages, and God knows what the next one will look like. But if I can leave you with these simple questions to think about, if you haven't already, you may have seen these before. You know, take our slide after. If I can point you to one slide, it's this one, and think about how you'd answer those questions. And also the other thing that I wanted to point out is it's important to involve the sponsor in conversations about long-term objectives and journey plans. Okay. Just to touch on something that Ellie's already mentioned in terms of actuarial evaluations, and it's effectively the submissions, and this is just a sort of representation of what Ellie showed earlier. So you got the proposal is to have a twin track approach. So you have a fast track, easier to get sign off from the regulator, but the bar is likely to be high, with everything else being bespoke, which gives schemes more flexibility, but they'll come with more justification. If I can have the next slide, please. So just drilling down into fast track and bespoke a little bit more. So fast track, the intention, certainly from the regulator's point of view, I think it's fair to say that it should be something that's easy to adopt and then sort of encourages a lot of schemes to do. And from their resourcing point of view, also something that will help to get schemes over the line in terms of actuarial valuation submissions. I think, interestingly enough, the first consultation did give a lot of clues as to the criteria that would be used to first track, or certainly proposed. And I think certainly across my client base and colleagues, I think it's fair to say that the bar is set fairly high, with criteria around how you set your technical provision. So how prudently you value your liabilities, but also around the investments that are held in the scheme, length of recovery periods, and so on. So I think I just put that a bit in red there because I wanted to make sure that for a lot of schemes, that means quite a significant jump in terms of the funding that they might be aiming for now versus what they might have to aim for in the future. Just one other point I wanted to make here is around the fast track measure potentially being a benchmark for bespoke. So that in effect would probably make it easier for the regulator to mark the homework when it comes in an actuarial evaluation submission. But there's been quite a lot of pushback in the sort of certainly in the industry as to whether that's feasible and whether that makes bespoke truly bespoke. And it'll be interesting to see certainly what that looks like going forward. So again, you may have seen it yourself, but there's a lot of press there. If I can just move to the next slide, please. Bespoke, which is basically meant to give you flexibility, and personally and across my clients and so on, I can see a lot of them are going to end up, certainly as it stands today, going down the bespoke route. Lots of reasons why that might be. One obvious one is that they simply can't meet the fast track criteria. And lots of schemes out there will feel that their strategy, or certainly aspects of their strategy, are robust enough and they have reasons to to stay not actually target fast track. From employer's point of view, there's some concern around potentially the new regime leading to schemes being overfunded, so they're likely to want to understand all the implications of the new regime. So I can see lots of reasons. I think one thing we know, and it's been hammered home over and over again in terms of Bespoke, is this need to have an audit trail of all the advice that you take. So certainly I guess when we're preparing for this webinar, I think our views are very much similar on that you need to make sure that you got all the documentation and all the decisions that you've taken, because the idea is that in future you'll have to submit that as part of your actuarial evaluation submission. Okay, hope that was helpful. And just as a final slide, please, next slide. Just really in terms of the sort of our experience about what schemes are doing in terms of the new DB code, I think it's fair to say that most are talking to the sponsor. It's important for the sponsor to understand the impact of the new regime, what it could have on them. Lots of analysis, as I showed you very quickly, a couple of graphs of how we're helping clients. So it's looking at the funding, it's looking at the different investment strategies and so on. Some schemes have already gone as far as deciding on their long-term objective, and they've got journey plans and so on. There are some that are still waiting. It might be that there could be changes and they don't want to do anything yet. I think it makes sense for certainly for smaller schemes and so on to maybe look at this in conjunction with the actuarial evaluation being a good time when you're looking at funding to look at the implications of the new code. So I'm going to, I think that completes my slides, and I'm going to hand over to Liz, I think, is that right? Or is it Ellie? Sorry.
It's me. Thanks, Marcos. Yes, Liz and I are going to have a look now at the pensions regulators' engagement with schemes. So how they're getting involved with our clients. What are we seeing there? So traditionally, as I'm sure you'll all be aware, the regulator typically engages with trustees around the valuation cycle. Since the regulator's new mantra of clearer, quicker and tougher, we have seen a change in the approach. The regulators become more proactive and more willing to intervene outside the valuation cycle. For example, in response to press reports about profit warnings or credit downgrades or a decline in the share price. So TPR's corporate plan for 2019-2022, so when the world was a very different place to what it is now, TPR said it would take forward a segmented and proactive approach to risk and intervention, and it would focus on ensuring adequate deficit recovery contributions and reducing the length of recovery plans. And I think we've all seen that amongst our schemes, particularly the reduction in the length of recovery plans. The regulator targeted particular sectors. Initially, these were media, publishing, then in the wake of VHS, retail, of course, and not-for-profit organisations like charities and trade unions. And we had clients in these sectors receiving these blanket standard letters, regardless of employer covenant and the specifics of the scheme. We also saw some schemes receiving some very active oversight, with the regulator attending some trustee meetings for one of our clients and giving tips on governance after the meeting. Then we had the regulator's corporate plan for 2021-2022. This is post-Brexit and with the experience of the pandemic. And you can imagine this is a slightly different approach. And in it, the regulator said it anticipated increased engagement and oversight of schemes where the employers were in financial distress. And therefore, with finite resource, other supervision work was expected to be leaner and more focused. And again, this reflects what we're seeing in practice. Clients in the targeted sectors have received letters prompted by press reports, as in the past, but these letters don't necessarily need any response from the regulator, response back to the regulator. The letters often come in response to a particular risk event, and they set out very detailed but general expectations of the actions the trustees should be doing, or at least considering whether it is appropriate to do them. In a recent example, the expectations included engaging with the scheme employer early on to understand the potential impact of the event, understand the employer's legal obligations to the scheme and the balance of powers between the trustees and the employer, and what leverage the trustees might have in negotiations with the employer, and then requesting information and putting in place an information sharing protocol, or where they already have one, considering whether it's sufficiently robust to obtain the information they need. There are also tips in there on doing a skills assessment for the trustees and reading the regulator's guidance. So trustees obviously need to take a view in each case, but on a recent example, very much like that one, we concluded that where the trustee was satisfied there was no material detriment to the funding position of the scheme, then it did not need to reply to the regulator. The trustee did carefully minute its discussions and its decisions so that there is a paper trail in place in the event the regulator comes calling in future. Some trustees will have a response plan already in place, and we found that useful. So when something happens unexpectedly, you've already got a process in place for calling an emergency meeting and carrying out an impact assessment, and then of course documenting it to show that the risk has been evaluated and what decisions have been made, even where your decision is that no further action is to be taken right now and you just continue to monitor the situation. So that's the letters setting expectations. And then the final box on the slide now, there are still cases where the regulator is taking time and working closely with trustees where it sees the most benefit can come from its intervention. And we have one recent example where the regulator took a strong view that a series of company disposals were of material detriment to the scheme. It was a scheme with a UK sponsoring employer, but it was part of a global group. And the share price of the UK company had declined in recent years. The regulator took the firm view that the recovery plan was too long and the employer covenant was not strong enough to support that recovery period. So what did we see happen in practice? The regulator got in touch and it used its information gathering powers. Initially, the trustees were concerned by having the regulator involved, but actually it strengthened their hand and they came to appreciate the engagement with the regulator. The information gathering powers managed to extract information from the sponsor, really helpful, up-to-date information that was sent to both the regulator and the trustee. And once that information was out in the open, it made it much easier to engage in discussions with the employer. And actually, as a positive result of this has opened up the lines of communication between the trustee and the employer, and they've got a better ongoing relationship as a result. The regulator wasn't prescriptive about what mitigation needed to be put in place, and it was open to a package of mitigation rather than just one single thing, and it was open to contingent assets rather than just a cash contribution. In this case, the parties decided on a company guarantee from one of the overseas entities, but there are plenty of other contingent assets options available. And we are seeing renewed interest in this area, which is particularly helpful for schemes where the employer has got the cash flow to make immediate contributions. So I think that's been a positive story of experience with the TPR. And I think, Liz, you've got another example of engagement with the regulator.
Yeah, thanks, Ellie. Yeah, we've got an example in the team where the regulator's similarly been very engaged for some time. This case is a large DB scheme where the employer is considered to have a weak covenant. So, as I've mentioned, lots of engagement and very much in the context of the current valuation cycle. So regular meetings with the trustees, regular correspondence following those meetings, and setting out very much in no uncertain terms the expectations of the regulator in terms of what the trustees should be following and considering, including that appropriate advice has been taken. And in this situation, the regulator's clearly got a whole range of areas that it's considering, but interestingly, long-term funding is increasingly being called out as something that the trustees should be considering. And the regulator's also indicated that it might consider further action in this case, taking into account the current proposed funding approach. Interestingly, actually, also this is another scenario where the employer has now offer to put in place a contingent asset as a means of satisfying the regulator that there's appropriate support being given to the scheme. So definitely a robust example, and more robust perhaps than in Ellie's case, and very much again demonstrating that the regulator will lean on trustees in order to ensure that they're being the appropriate monitors of the employer's behaviour, and making sure that the trustees respond as appropriate. But I think this example is also just that shift in the correspondence in the case that I've just mentioned on that long-term funding approach and how that fits into all the other considerations that the trustees are expected to have in relation to the scheme. And where that long-term funding approach, if it doesn't fit into the regulator's expectations, the threat obviously is of more investigation and action to follow. And certainly in all these cases, nobody wants to see a warning notice, but indeed, even leading up to that, it's the time and cost and energy in responding to investigation that no trustee wants to have to deal with or indeed sponsor. So I think what will be interesting to see through 2022 and into next year is how the regulator continues to engage with trustees and sponsors, given its array of the new powers, but also given these new funding expectations. So just moving to conclusions now before we move on to questions. And today, obviously, we've taken you through what we know about the expected changes to the funding regime and what trustees and employers can do when considering the long-term funding strategy, with some really helpful input there from Marcos around actuarial considerations. But also we're just awaiting on quite a bit of the technical detail around that coming in the regulations and also the second part of the DB consultation. So there's some areas for trustees and employers to watch this space, certainly those draft regulations and the various forms of further consultation. But key for trustees and sponsors, and hopefully that this has come through in the entire webinar, but it's that continued engagement in relation to DB schemes, so that both sides understand what the direction of travel is for the scheme. So it's not set in stone, but definitely focusing the minds in terms of what everybody's intending to achieve. Ellie mentioned this in relation to one of the case studies, but also we're definitely seeing an uptick in information sharing protocols. And certainly in our client base, many trustees and sponsors have now put those in place to regulate the flow of information. And from a sponsor's perspective, obviously agreeing that long-term funding target is a real opportunity to have that conversation with the trustees about the direction of travel, and for the sponsor to really have a foot at the table in terms of having that dialogue. We've also mentioned, but definitely key to take away, is just documenting the decision making. So we can see that there are various situations in which trustees and sponsors will need to take professional advice, be that actuarial or covenant advice or indeed legal advice. And the existing DB funding code already notes that trustees should document their decisions and the rationale behind those decisions. But that's absolutely going to become more necessary as we move into this new funding regime. So trustees and sponsors should absolutely make sure that they're focusing on that documentation and that audit trail for decision making, setting out the issues, the risks considered, and then the decision made, and ultimately looking at this long-term funding strategy. So that's all we planned on covering for the main part of today's webinar. I'm going to hand over to John, who's going to compare for any questions that we have that have come in.
Fantastic. Thank you, Liz, and thank you to all of our speakers for your insight. And we've had quite a few questions through on the Q&A. So sorry if we've got a few minutes left to go. We might not get quite to everybody, but we'll cover a few questions as we go. Probably one for Marcos, this one. Got ones about the long-term objective itself, asking about what sort of goal it might be. So is it self-sufficiency or buyout, which seem like they might be the most common from what I know. But it begs the question of buyout in particular. Is there going to be the resource in the market to deal with all the schemes that might be looking to go to the market?
Yeah, thank you, John. I think in terms of what the long-term objective should be, that's definitely a discussion, and we can see that in some cases probably sponsor-led buyout is going to be an option, or even once the market develops, the consolidators. I think that the experience we have certainly is that there are some noises that are made from insurers, and certainly with small schemes, the tendency is that they need to be patient and wait in an orderly queue. I think over time, especially if all schemes have a long-term objective and they're kind of going towards that low dependency point where they're more well-funded, certainly that provides a pipeline for the insurers market, and you'd expect that they'd be interested in upping the capacity, I'd say, but there might be some short-term kind of delays, maybe. That's what I think. Yeah, thank you.
Fantastic. No, thank you, Marcos. That makes some sense. Probably one here for Liz. You were talking about a particular case that you've worked on where the regulator has been involved on a particular large scheme. Is that what you're seeing as the regulator just getting involved on large schemes, perhaps ones that they're more interested in, more worried about, or are they looking across all sorts of sizes of pension scheme?
Yeah, it's a good question, and actually it kind of goes to some of the discussions we'd had with First Actuarial before this webinar, because I think there's a real range going on. I think there's quite a lot of high-level scrutiny going on in the context of valuations, and I think that can be schemes of all sizes. But it also goes back to what Ellie was saying around focus, more specific photos and more tailored letters. I do think they tend to be happening with larger schemes or medium to large size schemes. That said, there's no doubt the regulator will target employers where there is considered to be a weak covenant, I think regardless of size, or particularly, for example, retail sector or other sectors where the employer might have been particularly affected by the pandemic or post-Brexit. So it's a range, I think, is the short answer, and it's a range of different tools that the regulators clearly use and to try and get trustee engagement. And to deal with the point I mentioned around trustees being leaned on to make sure that they're being the watching out for what's going on and keeping the regulator updated.
Thank you, Liz. And probably another question that linked to both of those that we've had, maybe one for Ellie, to be fair. We've heard about so the regulators getting more involved with schemes of all types. They're doing more work along the way. And especially we might expect them to get even more involved with those that go down a bespoke method, and they're looking for a bit more work there. I've thought about resource for maybe insurance companies. What about the regulator? Do we expect them to be able to keep this up, to be able to keep going with talking to schemes and doing all the things they want to be doing?
That's a really good question. Resource is a key point for the regulator. It is stretched in so many directions with the Brexit and pandemic. We understand the regulator wanted the majority of schemes to go down the fast track route, and this would leave resource available to deal with the small number of schemes wanting to go down the bespoke route. But to make that work, fast track needs to be sufficiently accessible to the majority of schemes. And it might be that initially it's more accessible and they raise the bar higher later. But if it comes in as something that's too challenging and the minimum standards are too high, then the regulator could find more schemes trying the bespoke route, and it could challenge its resources. That said, we know the regulator is planning to become leaner and more focused, so it will just continue to be making choices about where it invests its time to make the most of the resources it has available. And I think it will be having trusting that trustees continue to do the right thing to try and meet regulators' expectations. Another point is, it's not unheard of for the regulator to come back later to a previous valuation. We've had clients who've submitted a recent valuation and then they had a letter from the regulator about the one before that. So make sure you document whatever you do now, because it might not be the last you've heard of it.
Absolutely fantastic. Thank you, Ellie. We're just coming up to the end, so we might just squeeze in one more question, if that's all right. Let's go for one for Marcos again. There you go, Marcos. Long-term objectives again. You've spoken about a scheme may look to set one of these, a long-term objective, and maybe a journey plan to get there. Do you think they'll be able to change it once they've fixed it? Will it be difficult to change, or is it a kind of a really big decision now because it's getting set in stone?
Yeah, so thank you, John. In fact, that's a question that a couple of my clients have asked me, and it sort of seems to come up every now and again. I think, like anything, there has to be scope for for it to be reviewed. One example I can think of immediately is that you might have a set of trustees that agreed with the sponsors to target self-sufficiency, and maybe down the road there's some corporate activity, or the sponsor decides that they would quite like a buyout. So that, you know, there needs to be a mechanism where the target can be updated. But I can see other milestones, other things that happen, changes to the circumstances of either the scheme or the business that might mean that a change is required. I imagine, again, from the regulatory perspective, that there's going to be some pressure to keep to the target that's agreed, but I expect there'll be room for changes. Yeah.
Fantastic, makes sense. Thank you, Marcos. We've reached the end of our 45 minutes. So just going to say thank you very much to our presenters for sharing that with us, and thank you to all of you for joining the webinar as well today.
Thank you.